So let's continue our discussion of macroeconomic impact. The Federal Reserve, or the Fed, is the central bank of the United States. Its primary goal or role is to manage the country's money supply and ensure economic stability. One of its key goals is to keep inflation under control while maximizing employment. So what is it there? What are their primary goals? Maximize employment, stabilize prices. They're to moderate long-term interest rates, supervise and regulate banks, stabilize the financial system. They provide financial services to banks, United States government, and foreign institutions. So they have many tasks, if you will, but their primary function is the supply of money. So let's think about interest rates. I think everybody understands what interest rates are, but let's think about what the impact is of changing interest rates. They influence borrowing, spending, and investment. When rates are low, companies like Apple can borrow cheaply to finance expansion projects. However, when they rise, it's the exact opposite, and companies might cut back on their spending. So as rates decline, interest rates go down, there's a demand for people to go out and borrow more money because rates and costs are low, and vice versa. We can view interest rates as a composition of several prices for different types of risk. So the overall nominal interest rate, or the interest rate that you see published, has some parts. The real risk-free rate, this is the rate that comes from the supply and demand for money, and obviously it is risk-free, so it implies there is no risk associated with this particular return. However, we do have different levels of risk depending on the security. The inflation premium. I think everybody understands a little bit about what inflation is, but as certain events, as certain companies or entities may have different levels of sensitivity to inflation. For instance, banks are very sensitive to changes in inflation. What about default premium? What's the chance that the company will default? Well, we know that what? The United States government cannot default, so its default premium would be 0. However, there could be companies that have an extreme amount of debt that makes them very risky. The amount of risk you have, the potential for you to go bankrupt, would depend or would have influence on how big this premium is. The liquidity premium. This is what is needed to induce the investor for investments to trade their transaction, right? So again, liquidity premium, the higher this is, the more incentive there might be for you to want to sell your asset. In other words, it makes it easier for you to sell. And again, we have this final term they call the term premium. Sometimes this is referred to as the maturity risk premium. This is the additional premium that induces investors for long-term investors, right? So how do I convince you to invest for 30 years instead of 2 years? I have to pay you more. So the interest rate that we see can be broken down into these different component parts. The Fed is there to help us manage this interest rate and the inflation and the other aspects of controlling money. So how can the Fed impact the economy? there are three main tools to control the money supply, right, and how to influence interest rates. The first is what's referred as the reserve requirement. Banks are required to hold a certain percent of their deposits in the vault. I mean, this is so important that every day, every bank counts its money. There has to be this reserve in the bank. If not, they will have to go and borrow it from another bank. So the more the bank needs to keep in reserve, the less there is out for it to loan. So that means there's less money for you and I to go out and buy things. Now, the Fed very rarely changes this because it's a very drastic measure to change. This would immediately cause banks to all react in the exact same way. So this would be like adjusting interest rates with a chainsaw. Not very subtle. What about the discount rate? So this discount rate is the interest rate charged by banks when they need to borrow funds for their reserves. It's a very important tool. This is the number that we see in the newspaper, right? This is the number, the rate that they are changing when they talk about cutting the Fed funds rate. If they increase the discount rate, it decreases supply and increases interest rates. So how does that actually work? Again, if the Fed increases interest rates, banks have an increase in their cost of doing business. They pass that on to us. So now it's more expensive for us to borrow money, which means we'll less likely want to expand our business or our product lines because now it costs too much money to do that. Open market operations, right? So when the Fed purchases Treasury securities, it's giving money to a bank. So the bank now has more funds to loan to another bank. So this increased supply decreases what's referred to again as this federal funds rate. So the changing the actual discount rate is one way to do that, but also by going out and making these purchases of securities is another way. So let's think about it. This is more of a fine-tuning kind of adjustment. So its goal is to change the actual supply of money in the economy. So if the Fed buys securities from you and I, this puts money in our hands. The supply of money available to us goes up. If the supply increases, we know that that is going to it's going to increase the supply of money. That's going to have an expansionary effect. There's more supply. So how much money is there in the economy? This is a little tougher than you might think, right? So there are two measures that we can talk about. One is called M1. This is the total of all the cash and demand deposits that are in the economy. So you take all the coins and currency in circulation, you take all the checkable deposits and all the traveler's checks, haven't seen them for a decade or so. That is what is called the M1 money supply. M2 is that amount, M1, plus all the savings accounts, the money market accounts, the CDs, any of those other time deposits. So again, this is the primary number that the Fed is trying to adjust when it makes changes in its monetary policy. So let's look at the money supply. This is M1 since 2000. As you see, M1 has been fairly flat all these years, and now in the recent years, since 2012, it started to grow. In 2020, what happened? Boom, there's a huge increase in supply. This is the money that was put into the economy by the federal government. This is what has caused all of our inflation over the last couple of years. And you can see it didn't stop there. It continued to grow. Now, over the last couple of years, we have seen it start to decline a little bit, but still it is substantially greater than what your growth curve could have anticipated prior to 2020. So what is fiscal policy? Fiscal policy involves government spending and taxation. When the government spends more money than it taxes, it runs a deficit, and it has to borrow money by issuing treasury securities. This can cause interest rates and crowd out private investment. It's issuing, so we're purchasing treasury bills. We're taking money out of our account and putting it into the bank. So again, this can increase the cost of business. It can increase savings, right? When the government spends more than it brings in, that causes all kinds of issues with the supply of money. Inflation is attributed to a great extent to this deficit spending. So to kind of sum up, macroeconomic environment plays a critical role in shaping investment outcomes. If we could understand GDP, interest rates, inflation, and policy decisions, we're better equipped to make informed investment decisions. Always remember, though, successful investors like Warren Buffett pay little attention to these indicators because Warren Buffett, they pay attention to these indicators because they drive market movements. You need to keep your eye on the big picture and you'll become a smarter investor. Thank you for listening to the video. I'll see you the next time. Bye-bye.